All right, what's up, everyone? Welcome to another week of Ask Me Anything, brought to you by the BYOB Money Multiplier team. We are here to answer all of your questions around infinite banking, real estate investing, personal finance, privatized banking, anything in those realms. We are happy to chat about, talk about, strategize about, and see if we can't share some knowledge here today. So hopefully everyone's having a great start to the holiday season. And let's get some questions in over in the comments, whether you're watching on YouTube, on Facebook, on Instagram, wherever you're coming in from. Throw those questions out there, and we will get those answered for you. We'll be back in 14 seconds, do a quick little around the horn, introductions, and kick this baby off. Be right back. All right, my name is Stephen Nagy, coming live and direct from Southeast Florida at the BYOB Hobe Hideout office. Let's see what's going on today. Beautiful day out. Got a Christmas tree going. I got my Santa Claus laid back, smoking a cigar, drinking a beer. Perfect for Ask Me Anything. Actually, I'll take a picture. I'll share in just a second. Other than that, hopefully everyone else is having a good start to the holiday season. I'll pass it over to Mr. Brain. Oops.
What's up, everybody? Brain Foods here, apparently, up here in North Idaho. It's actually been really warm this year. Actually, raining right now, not very fun, but thank goodness we're staying warm and all that kind of stuff. But yeah, just doing a lot of calls right now, getting ready for the holiday season. So with that, I'll go over to Mr. Linus.
Thanks, Brian. Linus Knoll here from Hopkinsville, Kentucky. Missed last week. I was sick. You might even still hear it on my voice, maybe a little bit. No, doing pretty good. We've got fairly cold weather here in Western Kentucky. You know, we've got something forecasted this weekend to drop to 13, and I'm just like, why don't I live in Florida yet? But one day, you know, it's coming. So I am busy helping people with learning and learning the infinite banking concept, learning more about it, and some people that have started that I help them get started with the process and help them implement. Love doing that. Love to help people, if you can't tell. And I am passionate about the concept. I've got a number of policies myself for the last 4 years now, 4.5. So that's me. What's up, Tess?
Hey, I'm Tess Hulick, and I am halfway between Detroit and Ann Arbor in Michigan. Insurance has been my life for my whole career. I spent over 30 years preparing the financial statements, but then decided it would be more fun outside of the four walls and joined this team. I just like what this process is, and it was kind of sad that inside the four walls, I didn't know anything about it. So I love being on this side and sharing this with the team. And now I'm going to go to, and I'm going to say his name because I just love to say it, Mr. Kovacevic in the center.
Thank you, Tess. So I'm on the other side of the pond of Tess in Buffalo, New York, and have about 6-8 inches of snow on the ground. Today is raining, so hopefully it'll clean off the driveway so I don't have to shovel. And, it's a awesome 37 degrees out, so it's a heat wave. And as usual, I'm still in my shorts and my Crocs, but got to put a jacket on now, so. And over to Mr. Cregador.
Well, thank you, Joe, and I'm glad the camera is here and up.
I got pants on.
All right, I believe you.
But they're shorts.
Yeah, so Craig Yenny here, south part of the Denver metro area, and we just wrapped up a wealth webinar with Mythbusters kind of things with Stephen and Chris. We talked about some of the misconceptions of IBC, such as, is it too good to be true? And so there's a lot of fun stuff we talked about on the session. But anyway, if there's any other questions, people were on the show and have some follow-up questions, we're here to help answer that. So with all of that, I'm going to go right down to Bree.
Hello, everybody. I am up here in Alaska, so don't talk to me about cold. Between all the earthquakes and then the 3 days of hurricane force 100-mile-per-hour winds that tore up quite a good part of two towns, we're chilly. So I'm looking forward to getting away from all that here in the spring, come March, April. So if you guys are wanting to do a call with me and Joe, or definitely with me, make sure you get them in before I go on that, because I'll be gone for a little bit. But I've been doing IBC for years now. It's what helped me get out of debt, not a paycheck to paycheck without increasing my income. I saw the power in being in control of your own money. So I was passionate about learning more, doing more, and teaching more. So I'm here to help answer all your guys' questions. With that, I'll take it over to Jason. Who's on mute?
Muted.
Voice.
Still muted.
No voice yet.
Oh, first time
There
ever
you
doing
go.
this. First time ever doing this. I did
There
it.
you go.
I did it. I'm here. I know what I'm doing now. Happy to be here. Happy to answer your questions. We already got some great questions in the chat. Thank you, Bree. It's good to see you back here. Joe, I'm glad, like Yenny said, that it's only from the waist up, because we don't need to see those getaway sticks, brother. So let's start rocking and rolling. Who's reading the questions today?
Yeah. Before we get kicked off, though, let me just I'll just share a quick little photo with you guys. This is in the front of my office. This is my Ask Me Anything Santa right there.
Nice.
Wow.
He looks like Say Hey Maze. Or Say Hey Maze from Major
bottom
League.
side, top side, you can see it all with Santa.
Yeah.
All right. Let's get to these questions.
All right.
Can you see Shauna's question? She wanted us to start with that one if we could. That was someone had asked. Yeah.
Sure. Well, that's not Shauna's, but there we go. There's hers right there. So a question from Shauna says, I've tried answering myself, but it sounds perfect for AMA. Is this even for me if I don't care about legacy?
I'll say for me, because I was not able to have children, I thought that I didn't want a part of this because I don't need legacy. But why wouldn't you want to keep all your money and then you can, I'm feedbacking, then you can help other people. Not sure why I'm doing feedback, so I'll shut up now.
Everybody is.
Everybody is. But yeah, for me, without children, I thought there was no purpose for it. But I believe that it's one of the greatest gifts I can give myself to manage my money so that I keep it internal within me. And then when I'm no longer here, I've already designated 3 people that I'll help. And their goal is to learn this process so they can continue it forward even when I'm not here.
Yeah, and her, she said the real question is, this seems only for people motivated by legacy, but I have clients that are using this to build wealth and keep their money growing as a way to grow the money. They don't really care about the generational wealth or the death benefit, but they plan on draining the whole thing out in retirement years. They plan on pulling the cash value out strategically and depleting the whole thing. So there's not going to be much of a death benefit left if they do that. So there can be other strategies for it outside of legacy, retirement. So
yeah.
And back to my example of what got me out of debt and paycheck to paycheck was because I utilized my policy a bit strategically and differently to arrange how I took care of that debt, freed up that cash flow, and was able to just keep more of what I had been earning. And that's when I saw, yes, being in control of your money, being in control of when you're paying stuff and paying yourself back, and having it all still compounding and working for you makes a huge difference. So even if you're not working on legacy, because I don't have any kids yet, it still helps make your life a lot easier coming from someone that broke a long cycle of just not handling money right. And this helped get my head right and helped me start thinking bigger about what I could actually accomplish for myself or for my family, that like my spouse.
Wow, you guys are awesome. Everybody's got their story about what this is for. But think of it this way, like Mythbusters, is this too good to be true? Right? So if you can have a place where your money's growing forever, where it's tax-free away from our TOSAM, where we can use it for anything we want without having to jump through any hoops. I mean, we're not focused on helping people just with the legacy. I mean, that is the folks that we are helping because they typically do care about someone or have something they want to leave money for, whether it's a foundation or something. But that's not the purpose of banking. The purpose of banking is controlling your money, having guaranteed growth, being able to collateralize that money and put it to work for all the things you're going to need in your life, for all the things you're going to purchase, all the things you're going to invest in, for everything, right? And then the death benefit, if you don't have someone or something you care about, well, that can cover your final expenses. That can cover any kind of outstanding debts you have. That can cover other things that someone else would be burdened with and not have you be a burden to them if that wasn't the focus, is legacy. So you definitely don't need to be motivated by legacy to control your money.
One of the main things that I discuss on my first strategy call with somebody is mindset. I explain to them that this vehicle, this is using the whole life policy, but I want their brain not to think of this as life insurance, but to think of this as like their own credit union. You know, it's John's credit union. This is where you want to warehouse your wealth. This is where you want to run your money through first, not Bank of America, not Chase. Why do you want them to make interest and make money on your money? You want to put it into your own credit union, John's credit union, so that John makes the money. So it's mindset in the beginning with most people, because of they just think life insurance is for death. Life insurance is for the living.
Joe, I'm going to give you something and everyone something kind of fun. The question I ask people at the end when they're getting ready to start their application process, when they're getting ready to see if they can get approved to be partners with one of these big mutual companies that we work with that pay dividends for the last 100+ years, is, okay, Joe, what are you going to name your bank? People freak out. They're like, what?
Awesome.
I get to name my bank?
Yeah.
I don't know. I'm like, you got 30 seconds. Life's on the line. Give me a name. And I'm like, by the way, I'm the only one writing this down. It's yours. So I think you should care about it enough to name it. But that's like, instead of telling them, hey, it's Joe's bank, like, what do you want to call your bank?
Yeah.
People have some really creative names. The weirdest one so far was the Crack Bank. I don't really understand that, but you know, it's so good. It's kind of like crack, I think. I don't know, but I never tried crack, so I don't know. So
now imagine if you could have all of the things that everyone just talked about, and there's more.
Yeah.
So God forbid you have some terminal illness. What if you could tap into a big pile of money for your care? What if you had a chronic illness? You know, so there are so many benefits with this this whole strategy, where it's not just legacy. So if legacy isn't important, you've got all these other things we just talked about. And there's a lot of them.
And no stress. You create all the rules. There's no stress like you would in typical financing.
Because you're in control.
Yep.
All right.
And Bree, it's so great to have you back.
Good to be here.
I think we can cover this question for the whole session. What do you guys think? Or Brian, you want to move on to the next one?
Yep. Derek has a question here. What do you think about exempt from tax withholdings for December? Then I'll get more on my Christmas paycheck. So, interesting question.
That's a tax question. We can't give you tax advice. And you could talk to your CPA and see where your finances are or what your income is at that point, at this point in time, to see where you stand. Are you in a position where you're going to get money back, or are you in a position where you're going to owe? Because you'd really want to know that before you make that kind of a decision.
Listen, if you're disciplined, you can set up a banking system where you pay all your taxes at the end of the year, run all the money through the policy throughout the year. Like as an employee, you can choose it, you know, where you're not paying taxes. Most people don't do that, but if you pay taxes throughout the year that way, it's just an interest-free loan to the government. So, you know, if you're getting any refunds or anything like that, it's an interest-free loan to the government. So there are different strategies for doing that. I mean, we can't recommend one way or another, but you know, if it works for you and you have a plan for it, you can cover it later. I mean, I don't see why not.
The way that question is, if this person put down 0 or 1 throughout the first 11 months, and then he goes in December and puts in 10, that means that less will be held from his December paycheck. So if there was enough amount that have been held between January and November, and you claimed a bigger amount in December to increase your paychecks, that just means that when you do file, you're going to get less of a return back or kind of even itself out. So that's what I kind of read off of that one.
Yeah. This is a great question, similar to the one that was just asked from Batman. It says, should I lower my income tax contribution throughout the year and put that extra money into a whole life policy and borrow against the cash value to pay my taxes at the end of the year? I mean, yeah, that's kind of one of the things that I do, because for my actually home insurance or taxes, property taxes, same kind of thing. So that can be a way to find cash flow to put through a policy and fund it, and then your cash flow really doesn't change because you're just putting it right back into the policy loan. So your cash flow doesn't really change in that regard. But yeah, that could be an option for sure.
Yeah.
The one piece I would caution on that is
same.
The fee.
I'm sorry, is someone talking?
No, go ahead.
Go ahead.
No, he was elaborating. He was trying
Oh,
to see if that was what he was predicting what you were going to say.
Oh, I got you. I was just going to add that if you're doing a strategy like that, you just want to think about how are you going to pay those loans back, because the last thing we want to do is just fill the policy up, take loans, and never pay it back. You might run into troubles at some point. So just have a strategy on how you plan on paying that loan back.
Yeah. So what I do.
Yeah, Craig, to further that, right? Like that's what I was thinking, exactly what you said, because if you start ending up with that debt where you're paying interest every year and you're only, the only savings you have is the money you're putting aside for your taxes, you're going to get in a situation where all of a sudden you're going to have a non-performing, like, yes, the money's making money. Yes, it's protecting you. Yes, it's doing all the things, but it's not performing and creating any revenue for you to kind of cover the cost of doing that. Right. So
what happens if you do that for 10 years and then in the 11th year, you're at 300% cash on cash? Wouldn't that be a way to backfill and fill that policy then?
And also, Craig made a good point. That's what I was mentioning too, is that if you don't pay any taxes and you pay it all at once, they will charge you penalty, kind of a fee. What is the amount? It's like $900, something like that.
I think, Joe, you said it was like around 600 or something the last time you had to pay it.
It depends, because I don't do quarterly. So I just wait till the end of the year and I pay the penalty, because I can use my money a lot more wisely than giving it to them 4 times a year and letting them keep hold of it while I can keep hold of it and keep making money. And it depends on how much the bill is and how much it was the year before. And there's a little calculation that's done to it. But at the end of the year, I calculate more in my pocket than in theirs. So it's a win.
Joe's estimated tax payment is 0.
If you're in the stage of where you're always focused on arbitrage and you're building investments, you're creating passive cash flow from when you draw from your policy loans, that's where it's easier to come to that evaluation of your money is better suited earning in a reliable contractual opportunity versus just sitting in the policy or going to Uncle Sam just to come back to you because you overpaid. So
yeah,
depends on the person.
And Derek has a good follow-up question. He says, W-2 employee, should I be exempt from tax withholding, save 12% of my paycheck in a high-yield savings account, and then I can just pay the taxes due each year with interest earned?
I would do my policy over a bank account, just because banks have been allowed legally to keep 0% on reserves of your deposits for over half a decade. 6 years come March.
So kind of personal choice right there on that one too. All right. All Eric says, is having an all-in-one HELOC better or worse than doing a policy to get out of debt?
Put them together and do them both.
I did because I didn't have a house, and now I just utilize the HELOC with the policy in tandem. It's a powerhouse combination, but either one does work.
Yeah. It depends upon your cash flow, the amount of HELOC you can get, how you'd fund the policy. Because with a HELOC, you get an instant access to the equity. With a policy, you've got to fund it first. So you can use the HELOC to fund the policy as one option, which is what they're referring to. So it just depends on what makes the most sense to you. And you just got to look at the different options and put them on the table and just kind of go through the numbers. So that's why you might want to schedule a call or talk to Joe.
There you go.
Okay, here's another one. So Nana Kid says, is there a minimum cash flow needed to have BYOB, Bank on Yourself, work?
That's going to depend on the person again, because what are the
Couple
bills?
factors, yeah.
Yeah.
Yeah. So, I mean, if you're looking for minimum to start a policy is 10 times your age per month. And the amount of premium maximum is 20% approximately of your gross revenue. So your maximum has to be above your minimum on the premium side, on a monthly premium side. So that's just the calculation that we do. So once again, 10 times your age per month for the minimum on the premium side monthly, maximum 20% of your gross revenue or income divided by 12. So those should hopefully be above that.
I found flaws with that level of measurement. Just like for my mom working part-time at her job, her minimum being 10 times her age is more than she could put in per her income. So it that wouldn't be efficient for her in that regard. But
it depends on how much is being left in the policy in the base also.
Yes.
So when people ask me, what is the minimum to leave in the policy? Can you say, how much money are you saving at the end of the month? 200, 300, 400. How much is left in your hand at the end of the month after you pay your bills and do your expenses, and so that's not hurting you? That would be the amount that you could leave in the policy. And then that would be the amount that you would be saving. So then the amount that you would run through would be the PUA that would be built off of that minimum. So there's different ways that I look at it.
With my first policy, I focused on the minimum times my age. And when I saw that I only had to leave $36 in a week after I started the policy, I was mad that my agent didn't explain it to me better, because now I was only contributing $250 a month into this banking system where clearly I'm getting access to a good chunk of change and from that, and was able to use towards paying off the debt and everything. So I started maximizing based off of my PUA limit. So that $3,000 a year policy after 3 years is now worth over $24,000 versus only around $9,000. So I don't focus on the minimum as much as what is the IRS, what is Uncle Sam sitting there trying to tell me I'm allowed to pay myself first? What's the limit of my income that I worked hard to go earn, that they're saying I can run through a system that buys death benefit and legacy for my loved ones, that protects my dollar's value and is accessible and allowing me to be in control of my banking functions? And there's a cap on that, 20-25% of your income. So, okay, I want to be contributing that, especially if I know that number goes down as I get older.
If Bree would have came to me beforehand, and that 250 would be what she was left in the policy, that policy I could build out to $800, maybe $1,000 a month that she would be then able to run through. If she's going to use that money to pay her credit cards or pay her car loans, and she ran it through the policy first, what did she do? She paid herself first. She's in control. And now she's going to be making dividends on that money until she stops breathing, only because she paid herself first. And she's still going to use that money to pay her debt.
What a panel. Nana's kids. Two thoughts for you. One, go get the book and read Becoming Your Own Banker, or watch our video, the 90-minute presentation again, because that question is one where we're going to specially engineer everything for everyone we're talking to. So like to Bree's point, if they would have understood what she was trying to do a little better, then they would have structured it differently, like Joe just said. But we're always going to set everything up where you have a manageable floor. Like that's what Joe says has to stay in the policy.
Yep.
You have to put this much in, usually plus $10 to keep the PUA attached, the cash part of it. But that's going to be your manageable floor. And we're going to make the ceiling up to maybe it's 10% of what you're earning if you're following the laws of wealth, or 20 to 25% of your income, depending on the carrier. So that's kind of my parameters, 10% to 25%. That way, if you make 50,000, 100,000, 200,000, $1 million, you're just following the laws of wealth. You're going to pay yourself first. You got to store it somewhere. This is an easy place to store it and use it for everything you're going to use it for.
Yep. All right, let's get into some of these questions here. All right, so Packet has a question here about the Fed. So why does the Fed push for 2% inflation? Doesn't that mean that we lose purchasing power at a rate of 2% a year? If that's the case, our money is useless, being that the Fed has been in power since 1913.
I have a video for you to watch that I send out as a part of my welcome packet after every initial call we do, called The Hidden Secrets of Money. It's a beautiful, fun, illustrated video with John Maloney of the company Gold Silver. He's traveled around the world talking about currency and real intangible value of money and what the differences are between all those terms. And that video, he is diving into how the American banking system works and the role that the Federal Reserve has in that, and how it's a system built on debt. And if you knew about what happened, like we saw in 1913, Preacher from Jekyll Island by G. Edward Griffin, that book dives into how a wealthy few who controlled more than 25% of the world's wealth created the Federal Reserve, a privately owned company, to be the liaison between money for the country, and created the banking system, the traditional banking system we know. So they don't care what they do that much. And if it hurts the little guy, it's still always going to benefit those in power, those that are a part of that system. So learn how to capture and how to look for the arbitrage so you can try and end up better than they want you to end up.
But the 2% question there, I mean, there's a lot that goes into that 2% thing that the Fed is trying to do, because they don't want high inflation, they don't want low inflation, they want that 2%, and there's a lot of factors that they talk about, but that keeps the economy, they believe or they say, from overheating. But there's a lot more that goes into that one. I've done the research on it. It's just I think they're all kind of a shell game, anyways. But yeah, I mean, you got to look at that arbitrage, because if the inflation is 4%, you don't want to be getting a 3% return on your money. You want to be doing more with it.
The Federal Reserve Bank, the ultimate deception. It's not federal, carries no reserves, and is not a bank, because you can't do any deposits there.
Privately owned company paying out dividends and profit to
I love the
shareholders.
name.
They post it right on the website. No one pays attention.
Yep. Yeah.
That's
I love
the
the
best part. That's the best part. No one's paying attention. No one. They tell us what it is. They show us what it is. All this stuff that we're saying. Don't believe anything we're saying, by the way. Like, I wouldn't. Like, go research the stuff yourself. We want you to think for yourself. That's how we mentor. That's how we guide you. You're coming to us knowing there has to be a better way. It must be too good to be true. I wish I knew this 20 years ago. And then you want a different path forward. Go think for yourself. Ask great questions you're asking, but at the same time, go research it. You can go as deep down the rabbit hole as you want, and you'll come up with your own conclusion.
You'll get more mad seeing the guys who invented it had IBC policies. They knew about infinite banking. They knew about preserving their wealth and their life insurance.
Yep.
But we won't talk about that. Keep going.
Happy Insing says, have a $440,000 mortgage. House is worth $1 million. What is the best way to do 100K repairs and to pay off house?
Get rid of that mortgage and turn it into an all-in-one HELOC at the maximum LTV you can.
Yep.
And then run it through a policy to pay yourself first, and then utilize that to fix the repairs, or put that into an opportunity, bring you interest, and use the interest to fix the house.
That way, that $100,000 you spend on repairs is still compounding in your policy, providing death benefit until you stop breathing.
Yep. And I have a client do the exact opposite of that. We had a client recently that got a HELOC to do velocity banking. Then they wouldn't use the equity from the HELOC as a down payment on a new truck.
Don't do that.
What's wrong with that? What's wrong with that?
Don't do that.
A little bit backwards. Yep.
Yeah, they wouldn't create bad debt with the thing that could actually get rid of debt.
Yeah.
So they couldn't do velocity banking. All of a sudden, they were actually saying, "Why is this velocity banking not working?" I was like, "You created bad debt first.
You didn't put any gas in the tank. Where's it gonna go?
Well, I said, what happened was like you don't have any cash flow because you didn't pay off any debts first to create the cash flow to go through the velocity banking engine. And they, it was crazy watching their brain think about that, and all of a sudden it clicked. They're like,
oh. Losing his mind today. He started shouting, and he's like, "Oh my gosh, Joe, I would have the money." And it was a good love the aha.
So they had the right tools, they just didn't have the knowledge. There we go.
Right. Yeah.
Yep. So Derek had a question here. Cash value life insurance policies. Can I use my Christmas paycheck to do a cash dump into a policy? Is there a minimum amount so I can get my cash value building quicker? Well, there's a premium, which is monthly or annually, however you want to do that. And then you have the dump in. There is no minimum dump in. There's a maximum based upon premium, but the minimum dump in is actually 0. So yeah, you could take your paycheck or bonus and put it into the dump in to get access to 90% within 30 days. Yeah, that could be, that's a good option, potentially.
Now, is it in
Find the loose money that went through all the cycles.
Yeah.
So is this like, so this we're assuming is to start a policy, not an existing policy?
Yeah.
I'm thinking to start one.
Jump
Yeah.
into a policy,
Yeah.
Because
So
even
the-
if it wasn't existing, you could still call and find out if there's room to dump that Christmas bonus in.
Correct. If there's
Yeah.
PUA that hasn't been utilized, definitely max fund that policy before the end of the year.
Yeah.
Yep. And this one, another question here is a good one. How much equity as a percentage do you need to get an all-in-one HELOC?
The difference of the LTV for the HELOC, typically at least 20%.
So you got to think of an all-in-one, or is this, yeah, to get an all-in-one, what you're doing is you're getting up to 80% to 89% of the house value. So as long as that 80% is more than what you owe in a mortgage, then you're to the good, and you would get out of amortization and get into simple interest. Depending on how much room you have, now after you do that, is there enough room to debt consolidate? Are there credit cards? Is there a car loan? Is there any left over after that? Now you can run that through the policy and put that into an opportunity. So it just depends on how much the house is worth and what you owe on it, and then I can calculate that out and pre-qualify you.
All right. Christopher has a question here. It says, hey, everyone, I'm 19 months into my IBC policy. So first off, congrats. Joe is actually my original mentor, and fun fact, they share the same birthday. But, he was able to pay off all of his $9K in credit card debt and 2 personal loans using this concept. And Joe obviously showed him how to do that. So that's what we help you do. So that's a great example right there of what someone did working with one of our team members.
Good job, brother.
Yeah.
Yeah, it's awesome, man.
Yeah, thanks for sharing. It's always awesome when people pop in to share their wins. We love that. And I love what you did earlier, Fal, say, don't do this. I think we should do that more on this. When someone asks something and we answer what they should do, that's not what they shouldn't do, because that's what most people, not you listening, but most people are doing exactly the opposite of what they should do with money.
It's actually a good point to make out there, because we always say this is what we do, this is what you should do. But there's definitely things you should definitely not do with infinite banking or just in general. So, yeah. This is a good one. I love this one. Whole life with cash value versus an IUL. So what he's asking here is, for infinite banking, is it whole life or is it an IUL? Because they both have surrender value or cash value. Just go and Google IUL Kyle Busch,
Yes.
IUL lawsuits.
Yes.
You don't even need to make it that far. IUL, and it finishes out the rest in predictive text on the
Yeah, just type in lawsuits and legal issues and all that. And can you lose money with an IUL versus a whole life? I mean, there's so many Google things you can do, and we also have videos on that, but we don't touch IULs, put it that way. And a lot of us have personal experience having IULs or VULs. So I say that from personal experience. I will never, ever even look at an IUL. So for
Whole
infinite
life
banking.
been around since 1845. IULs have been around since the early 2000s. I hear IUL, I want to kill it with fire. So that's just my personal opinion.
So Streeper has a question here. I've been hearing that there is a certain trust to run assets and money through so you don't have to pay taxes. Is this true? I'm not an attorney. We're not attorneys. This is not legal advice. But if you're thinking that you can do something with a trust and not pay taxes, go talk to an attorney. Because I've heard this before. I don't know if anybody else has. I stay away from it as far away as I possibly can from that. Anybody else want to comment on that one?
Yeah, you're either very gray there, you're in the black, which is, illegal, or you're in the red, which is very illegal and purposely fraudulent. So you're somewhere in the not legal to very illegal, and if that might be too good to be true, and you should run the other way. That's just my personal opinion.
You always have to pay taxes on the money that you use. Depending on other circumstances, things can be deferred. I'm going to leave it at that.
Yeah.
Well, how about this? There's a 7,700 page rule book that the wealthy know how taxes work, and you can go use that rule book and look for ways to pay wealthy the same way the really wealthy do, which is less than the average person. They're doing it legally, following guidelines, and it's just not one thing. There's a whole game being played. It's not one thing.
It's not built to break the law. It's built or to evade taxes. It's built for strategy of following the little parts of the tax code that the many everyday Americans that are reading and studying the tax code just happened to miss when they were reading through it.
Go ask Wesley Snipe how that worked out for him, by the way.
I'll say one more thing. Justin, you're not wrong, but let's leave it that way.
Well, and I kind of like, and I don't remember who told me this once. I can't remember where I studied it, but the idea is you should never create something for the purpose of tax evasion. You want to create something to minimize taxes, but if it's to evade taxes, it's automatically a no.
Yeah, that's what Chris would say if he was here.
What was that?
That's what Chris would say if he was here. That's what he says every time.
I heard it somewhere. Just didn't remember
Jason
where.
mentioned this book that's this thick. What people don't realize is this many pages, about 10 or 20 of that book, tell you what not to do. And the rest of it tells you what you can do in order to minimize taxes. So somebody who read this much instead of this much knows a lot more than needs to be said. So I'll leave it like that.
There we go.
Hey, Brian, at the beginning of our Ask Me Anything here, I think Leon dropped some questions in here that we might have missed. And I apologize about that, Tony. In the beginning there, what does it say? Do you still offer? No, a little further back. Hi, I came across you all about a month ago, watched so many of your videos on YouTube. Do you still offer mapping after opening a policy?
Oh, yeah, I've seen that question.
I know about the vault and I'm going to subscribe, but would love to have a person with your knowledge help with a strategy and help me with those things that I don't know.
So yes, we do. We still offer that service. Yep, hasn't changed. So we have our implementation team, and obviously our mentors as well can help you at the very beginning, and then the implementation team can work with you on an ongoing basis on using the policy correctly.
Yeah, Tony, when we were on a call, you and I and Tess, that's actually the software we were using as the vault to be able to show you, and we can load that plan directly into your vault profile if you sign up there, and therefore you have access and you can play with it too. And the implementation team can also help some with how to work it in the vault and exactly how to execute your plan then.
Yeah, and Tony, also, if you are a subscriber, every 2 weeks on Thursday, we're going to do our next one on the 18th, but we do a session called Cracking into the Vault. It's an open Zoom. Everyone just jumps in. They're on camera. They ask questions. So it's a great place to learn and hear what other people are doing. So that could be an opportunity in addition to what the implementation team does.
And you can say hi to the rest of us on there. We're in that call too usually.
This is kind of an interesting comment here. So Chris mentions here, I've noticed the last few months that my cash value in this policy has had little interest deposits trickle in, which has been very encouraging. I've never noticed that on any of my policies. Anybody else notice that?
Yeah, I know.
Yeah, Patty and I actually started tracking. We go in weekly in our money meeting and we go to the policy cash value and actually look at it, and we actually date it and put it there. Like one of the policies grew like $1,000. Most of them are growing a few dollars a week, $10 a week, $20 a week, but it's just exciting to see. Like, look, it's growing every day, no matter what, and you get to see it on a regular basis with some of the carriers. So
that's kind of cool.
Yeah, it's really cool. It's really fun. Kudos to Patty. She figured that out and started tracking it every week and put it on our spreadsheet. So it's good stuff.
All right. Another question from Elric here says, if you have enough equity in your house and you start the HELOC and then you go to fund a policy, can you fully fund the policy with the equity in the HELOC?
I do.
Yeah.
If you do an annual build and a dump, for sure. But if you're trying to say a one single payment policy, absolutely not.
Well, it depends on the size of the policy, depends on the size of the HELOC. And there's a lot of factors that go into that, because you can't always hey, I want to have a $200,000 dump in. Well, you've got to qualify for that. You might not be able to put that much in up front. So it just depends on your numbers, and then see if you can do that.
I just saw the way they said fully fund. I just want to make sure they're not thinking they're going to pay one time to have a policy for the duration of their life. And that would be something I'd absolutely not do.
Right.
Yeah.
No, these are not fully funded with only one. This is an ongoing yearly deposit that you want to run through your banking system.
Yeah, they're not
Starting it with a dump, with a HELOC, and utilizing that for even the first annual deposit. Sure, not a problem. But it just depends on your numbers, your income, and everything else to go with the strategy.
Yeah, I have a client right now that wants to fund a policy. They want to put $144,000 in, but they can't qualify for, on a large enough premium, or they can't put that premium in to the policy from their cash flow to support that large of a dump in. So they can't do it. So what they're doing actually is we're trying to get as much into the policy as possible from the 144. So what we did is we said, okay, what's the premium that he can do? We know that number, and then that supports this X amount of dump in. And then what he's doing is doing an annual premium. So he's getting more through the policy by doing a dump in and an annual premium instead of monthly. And then the following year, he'll just go back to monthly for his cash flow. But that'll get as much of that 144 that he has into the policy day one. So there's some ways to do that, different ways to do it.
And what you shouldn't do is I get nervous every time I hear this question. Like if you got Joe or Bree or someone who's using the system guiding you, that's awesome. But if you have really bad saving habits, you spend a lot and pay a lot of interest, and now you want to open a HELOC, you want to get a HELOC so you can utilize it to fund your policy, and then you want to make sure that you're really doing this and understand you got to pay yourself first. You got to follow the laws of wealth, the principles, right? You got to understand how the system works together, because we don't want you leveraging your house or putting things at risk if your habits are really bad. If your thinking's off on this, it could be a mess. So I get nervous every time I hear us talk about this.
An easy way to say that is if you're spending more than you make, that doesn't work in any system.
Yeah, in any system, that's right.
That's right.
Yeah. This is funny right here. So this is someone said, it's my understanding that you, Brian, will be the mentor for a coworker. So if his name is Brian with a Y, then I spoke to him again today. So there you go. All right, Tony, Angie. What's the latest on what's going on with MSTV? What are the plans for the future?
That would be Mr. Nagy.
Yeah. Great question. What's the latest on what's going on with MSRV?
MSTV.
Oh, I got you. Yeah, I mean, it's, we have a lot of content on there right now as far as the live shows go. We have not come up with a plan for that yet. So check out all the content. Let us know if we can help with anything on there, and we'll see what we can strum up for it here in the Q1 next year.
There you go. Batman says, when you get a policy, how soon will you be able to borrow against it? 30 days. 30 days.
Within
Sometimes sooner, but we say 30 days just to make sure we set that precedent. All right. If you pay your credit cards off every month, would this system work?
I've never paid an interest payment on a credit card, and it definitely works for me.
So, yeah. So, I mean, if tell you what system you're referring to, infinite banking, I mean, your credit cards really don't come into play unless you're doing velocity banking. So
when you think about the infinite banking concept process, I always look at is you're either in debt, we need to get you out of debt to get to the next thing. So if you're not in debt, the next question would be, do you have major purchases, cars, a new roof, new windows that you might want to use a policy for. Or you might go to the level where you want to use it for emergency funds as well as opportunity funds. So any of those situations work very well with infinite banking concept process. So it's not all about debt.
Yep.
It's not really about debt at all. Just happens to be that's where most Americans are, right? It's really about controlling the banking function in your life, period.
Yep. And the preservation of your dollar's values.
I get a jump, guys. It's been awesome. Ariana needs to be picked up.
See you, Joe.
Bye-bye. Have a good day.
Give her a
Super
hug.
Dad.
Tell her hello.
All right. Douglas has a question here. It says, when watching the video, it mentions we stop paying after 10 years. Why is that? Does the policy not work anymore? Now, if the video refers to, I don't believe that it says we stop paying. We reduce the PUA rate of additions because the policy has become efficient. You don't have to stop putting in the PUAs in most cases after year 10. We just illustrate it or show it that way to show the efficiency of the policy. But by all means, if you can, keep on putting it in after year 10. But if you see an illustration where the premiums go to zero, what's happening is that the dividends coming in essentially are funding the premium. That's one thing I always going to note. The premiums never go away on a policy. They're just being paid or funded by the policy itself. So they're still there. It's just a portion of the dividends go back into that premium. But
and what you might see there is if you had something called a 10 pay, then you would pay premiums for 10 years. On that 11th year, in some companies, you wouldn't be able to put anything in. Some companies you can sprinkle a little in, but I suspect what he's talking about is what Brian was saying is the part of the premium that's covering the base portion of the policy is what continues. The extra paid up addition is what's showing not going anymore, but that's all. At the end of the day, it's like, what problem are you trying to solve? And then we'll build a policy to help you get there. So you may be paying for 15 years, 20 years, 30 years, 50 years, and it's all part of the design that we do for you.
Yeah, and one thing to note on this one, let's say you have an illustration that shows the full amount going in for 25 years, and then we show you another one that shows it going in for only 10 years. That doesn't happen automatically. That doesn't drop off at year 11 automatically. You have to call in and request it, or call us up and request the premium to be dropped off. It's not automatic. So oftentimes what I'll do now, because I've had this conversation so many times with existing clients, is I'll do two illustrations. The one showing the drop off at year 10, and then one showing the maximum they can put in through the life of the policy. They're both the exact same policy. It's just one is showing that option of it dropping down. So that's part of the education and talking to your mentor that we're going to help you understand. But good question.
For us, the first two that we show is one, usually what the client asks for, which is typically coming from a scarcity mindset, because they still might be treating it like it's just a bill. And then the other being the maximum amount that we could do per the IRS guidelines, and show them, look at the comparison of what's being left in going towards base on both of these. It's a very minimal difference, but so much more that you're getting to pay yourself first with. And it's having a huge impact in the short term, the midterm, and years down the line when you're still able to contribute, and we can keep that on or just put it at base. But all the policies become efficient by year 10, year 11. They're, as Joe puts it, 200 to 300% cash on cash, just because of the way the compounding works. And it's incredible. I wouldn't want to stop contributing new money into the policy just to keep the engine really revving.
And the other reason why we oftentimes show that is to show the efficiency, but depending on the age of the client, you can do more policies. So you might want to, hey, this one's now growing great. Let's go ahead and take that cash flow and put it into a second policy or a third policy and just keep perpetuating the cycle and start growing more branches of your own banking system. So that's another reason why we show that.
Have all the banks on the blocks that you can.
I have a client where they were doing $20,000 per the first 5 years, and they dropped it down to $3,000 in year 6. Their plan, this is a female young in her 30s, his plans on doing more policies to keep doing that.
Yep.
So there's different
I took that $250 monthly one. I'm going to keep max funding it because it's not much, and it's $3,000 a year. But I'm going to keep putting in the PUA as long as I can. Let it keep decreasing in amount. I still got my new one going that's $12,000 a year, and I'm beyond excited to schedule out when the next one needs to be started.
Yep.
And I did see that comment from Douglas that you popped up about what's the catch. I'll challenge you to go find what the catch is, because we all wanted to know the catch too, and we're here because there was no catch for us to find that didn't support getting involved in it. So dig in.
I see that. For me, I'd say you have to leave some. You can't take out 100% of what you put in for the first few years.
Yeah, that would be the only cut.
Yeah.
But then you can take out a lot more than what you put in just a few years down the road.
Muno Spam Fro 4263. That's a mouthful. All right. They said here, I believe they're talking about using money from an IRA so the money you make back goes back into the policy tax-free. This might be a response to a previous question. I don't know what it is, but you can't really take money out of an IRA and put it into a policy as a kind of an investment or a loan from the IRA. Because if you have an IRA that's self-directed, by the way, and you want to put it into certain assets, there are only certain things you can put that money into. I used to have a cheat sheet on this that I give to people that show them, hey, this is what you can do. This is what you can't do. Like you can't put in IRA funds, assuming you're not 59 and a half and you're just taking money out to go put it into something, into a piece of real estate that you're going to physically work on or your family or relative are going to live in. You can't do that. There's all these restrictions, and I believe pretty certain that life insurance policy is not something you can put in IRA funds into as a strategy for the IRA. Now, if you're talking about after 59 and a half, then of course, yes, you can take the money out of the IRA permanently. So, but I don't know if I'm reading that question correctly or not.
These policies have been around since, like I said, 1845. The IRA came out in 1974. The 401k came out in 1978. And Ted Benna said in the book, The 501k Plan, he doesn't use the 401k and calls it a monster, recommends the 501k plan, which is one of these upside down and backwards whole life policies. And then the Roth IRA is younger than I am. That came out in 1999. And then, of course, IULs in the early 2000s. We're talking about after-tax dollars going into the policy like it's always been. But if you are tax exempt through your work or you're, waiting for paying taxes through your business, then there is the opportunity for you to put your dollars into your policy with the knowledge that you're going to be taking them out to use them to pay your taxes.
Yep. All right, 2 minutes. Let's get through the last 3 questions here. All right, Derek says, what are the steps to getting started with an all-in-one, and what percentage of equity do you need? Well, you can talk to Joe or anybody on our team about some of that stuff. That's 1. 2, talk to the banks that do the all-in-ones, First Savings, CMG Financial, to see if you qualify. That's kind of the next steps. And then equity. So they'll typically lend you a HELOC up to 80% of the value of your home. So there you go. So if your home is worth $1 million, you got a $500,000 mortgage, all in one could be up to $800,000. It would start with a $500,000 bounce because it would absorb your mortgage and pay it off. So hopefully that makes sense. Let's see here. How exactly do you start a policy? Who wants to get one?
Get on a call.
Yeah.
There's a link over there, the mentors.beyourownbanker.com. Go ahead and get scheduled there. You'll get any one of these fine faces on the call. So go ahead and schedule the call. We'll be happy to help you guys.
Yeah. And here's a good one. So Bryn says, what can you do with an old traditional whole life policy? As it can it be transferred or turned into one of your policies? So that is an option. Yes, you can do a 1035 rollover, but only if it makes sense. Because if you have an old traditional whole life, it might be efficient right now as far as the growth of the cash value. It might not make sense to do that. It might just make sense to use it as infinite banking. But we can hop on a call with you and answer that question in detail. So, all right,
we did it. We made it.
We made it. All right. Well, that's another Ask Me Anything. I think we've got, how many more are we doing? We're doing all of them through the rest of the month?
No, next week. And then we'll see you guys in the new year, is from what I understand.
Yep.
Yeah.
So stay tuned for next week. Hop on and we'll do it. So
come be festive, bring drinks, bring party hats, and let's have fun. We'll see you next week.
All right. Take care, everybody.
Bye-bye.